Hi you guys, so you decide you want to start saving money for your child's college education. What's the best system to do that? We're going to talk about the 529 plans coming up next, Firefighter's Financial Toolbox. Hey you guys, welcome back. Today we're talking about 529 plans. First of all, if you look at my investing priorities, I tell you the last thing you should be investing in is your child's education. Now that may sound crass, but let me explain what I mean. Your child has other options to finance his college experience. He can get Pell Grants, he can get money from financial aid, these sorts of things. Nobody is going to finance your retirement if you do not. Enough about that. Let's talk about a 529. What is a 529 plan? 529 plan is Section 529 of the IRS code that states it is a savings vehicle for education in which you put in after-tax dollars. They're allowed to grow tax-deferred, and when you take them out, as long as you use them for qualifying education expenses, the money comes out tax-free. So all the growth that you make is tax-free. Each state in the union has its own plan, but you are not required to use the plan from your state. Let me explain what I mean by that. I live in Oregon, where we have the Oregon College Savings Plan. If I elected to, I could use, let's say, Nevada's 529 plan, and it would be fine. Now, certain states have different rules on deductibility, and if you don't use their plan, you're probably not going to get a deduction. Here in Oregon, if you don't use the Oregon's plan, you can't take advantage of the small state tax deduction, which is about $4,800 that you can write off against your Oregon state income tax. Now, each state has their own rules, so make sure you check your state's rules before you make a decision about that. There are plans where states that don't have any income tax also have good benefit. I believe there's 7 states that have income tax that do not give a credit or deduction for the 529. So it might be a good idea to look into possibility of using a different state's plan to take advantage of your taxes. What qualifies? Any higher education qualifies. And as of last year, you also have up to $10,000 per year for K through 12 expenses at special schools as well. But we're going to talk about college savings because that's what it's primarily made for. So what counts as qualifying expenses? Tuition, room and board up to the level that the college states. What does that mean? So let's say you can't get into the dormitories and you're forced to live off campus in an apartment with a bunch of roommates, but your rent is more expensive than what the cost of the room and board would have been in the dormitories. You're only allowed to write off that amount. Other expenses, computers and computer peripherals. It's now expected that if you go to college, you need to have a laptop and probably a printer to print out your homework. So these are all good expenses. Books are expenses. Now, other things you can't write off. You can't write off insurance. You can't write off your cell phone. You can't write off sports if you're doing that as a side hobby. So there's some restrictions. Make sure you understand what counts. It's important that you do that so that you don't get taxed. So what happens if we put money away for little Johnny and Johnny decides he doesn't want to go to college? So now let's say I've got $10,000 in this 529 plan and my son is elected not to go to college, not to use it. Well, you're in a bit of a conundrum. You can change the beneficiary. When you set it up, you set up a beneficiary in that name. So my son, for example, is the beneficiary of his 529 plan. But let's say he didn't go to college. First thing I could do is if he had a sibling, I could change that money over to a sibling's name. Or I could change it to my name and I could use it for higher education as well, or my spouse. But let's say that that doesn't work. I've already got my degree. I don't need to go back to school. What can I do? Now, I can cash that money out, but be aware that I will have to pay taxes on it at ordinary income levels, and I will have to pay a 10% penalty on any earnings. So if I have, let's say in the $10,000, $7,000 of it I put in, but $3,000 are earning, I would have to pay a 10% penalty on those $3,000 of earnings. So that's something to think about in addition to the amount being taxed at whatever your ordinary income level is. There's also a new plan to roll it over to an ABLE account. ABLE stands for Achieving a Better Life Experience. What this is if you have a child with a disability. If you have a child with a disability, you could roll the money from a 529 plan over to the ABLE account, and that can be used to pay for the expenses that you have with that special needs child. This is a new thing, and it's not available in all states, you guys. Remember, states can change the rules for their plans. You're never taxed federally for qualified expenses. Now, there may be states out there, and I don't want to speak to all states because I only live here in Oregon, that give you some sort of deduction, but there may also be some states, and I don't know that there are, but make sure you check to see if there's any state income tax that might be due if your state has state tax. All right, you guys, 529 plan. It is a good plan to help you use your money and get it to grow tax deferred and use the tax advantage of not having to pay taxes on it when you take it out when you do use it for qualified expenses. If you have a state that has a really good plan, or you have a state that has some sort of special deductions, let me know in the comments. The more we share our experiences and our own private endeavors in this community, the more we're all going to grow as better investors. All right, you guys, I hope you got something out of this. If you did, give me a like. Think about subscribing to the channel if you're not already. It really helps me. And if you have any other questions you want to know, let me know. We'll talk about it. All right, thanks a lot.